Welcome. Today, we're going to examine a company that has become a case study in modern strategic management. It is a company that defies traditional categorization, neither a pure operating business nor a conventional investment firm. It is an experiment in what happens when one person's long-term vision meets unprecedented financial firepower. We're talking about Softbank Group. Disclaimer: this video does not constitute financial advice. The analyses expressed reflect independent personal viewpoints and are not endorsed by, affiliated with, or representative of any professionals or educational institutions. The creator expressly disclaims any liability for financial losses or damages arising from investment decisions made based on this content. Softbank's story is not just about a company, it is about the nature of strategic ambition. It raises fundamental questions that every business leader and strategist must confront. How do you balance vision with risk? How do you build a sustainable competitive advantage in an industry defined by constant disruption? And what happens when an organization's strategy becomes inseparable from the personality of its founder? We will explore Softbank's history, its current strategic position, the sources of its competitive advantage, the quality of its governance, and the risks it faces. We will do this by drawing on strategic frameworks used in top business schools and by examining the company through three distinct strategic lenses, each representing a different philosophy of how to build and sustain value over the long term. Let's begin. Part 1: The evolution from software distributor to AI empire. Softbank's history is a series of strategic pivots, each more audacious than the last. Phase 1: The foundation from 1981 to 1995. Softbank was founded in 1981 by Masayoshi Son as a software distributor in Japan. At the time, software was a nascent industry, and Son saw an opportunity to build the distribution infrastructure that would fuel the digital age. Within a decade, Softbank had become Japan's largest software distributor. But Son was already looking far ahead. He understood that distribution was just the beginning. The real value lay in owning the platforms and networks that would define the future. Phase 2: The Internet Bet from 1996 to 2015. The mid-1990s saw Softbank pivot from software distribution to internet investments. The company made a series of early-stage bets on companies like Yahoo and, most famously, Alibaba. The Alibaba investment, a $20 million seed round, would eventually generate returns exceeding $150 billion. This phase established Softbank's reputation as a visionary investor capable of identifying the next big wave. But Son was not content to remain a passive investor. In 2006, he made a bold move, acquiring Vodafone's struggling Japanese operations. This was a classic turnaround strategy. Instead of competing on price, Softbank invested heavily in network infrastructure, partnered with local handset manufacturers, and leveraged its existing internet assets to create a differentiated customer experience. Within a few years, Softbank Mobile had become a dominant player in Japan, providing a stable, cash-generating telecom business that would serve as the foundation for future gambles. Phase 3: The Vision Fund era from 2016 to 2022. The 2016 acquisition of ARM Holdings, a British semiconductor design firm, marked a turning point. ARM's chip architecture powers virtually every smartphone in the world. It was a bet on the Internet of Things and, as it turned out, a prescient bet on the AI revolution. Then came the Vision Fund. Launched in 2017, it was the largest technology investment fund in history, backed by sovereign wealth funds from Saudi Arabia and Abu Dhabi. The Vision Fund was not just a fund, it was a strategic instrument designed to reshape entire industries. By writing checks of $1 billion or more, Softbank could anoint winners, force competitors to consolidate, and accelerate the scaling of startups across sectors like ride-hailing, e-commerce, and logistics. The Vision Fund era produced spectacular wins, investments in companies like Kuong, DoorDash, and ByteDance, but also spectacular failures. The most famous was WeWork, a co-working company whose valuation collapsed when its governance and business model were exposed. The WeWork debacle became a defining moment, forcing Softbank to confront the limits of its growth at all costs philosophy. Phase 4, the AI Pivot 2023 present. In the aftermath of the Vision Fund's losses, Softbank underwent a strategic reset. The sprawling empire was slimmed down. Non-core assets were sold. Companies' focus narrowed dramatically. Artificial intelligence. Today, Softbank is executing a clear, vertically integrated AI strategy. It controls ARM, the architecture that powers AI chips. It has invested tens of billions of dollars in OpenAI, the leading developer of large language models. And through its telecom arm and energy subsidiary, it is building the data centers and renewable energy infrastructure that will power AI at scale. This is no longer a generalist investment firm. It is a company that has placed a single massive bet that artificial superintelligence will define the next era of human history and that Softbank will be at the center of it. Part 2: the strategic position, assets, structure, and performance. To understand Softbank's current strategic position, we need to look at its assets, its financial structure, and its performance. The core assets. Softbank's value today is concentrated in three main areas. 1. ARM Holdings. Softbank owns approximately 90% of ARM, a company whose chip designs are found in over 25 billion devices annually. ARM's architecture is the standard for mobile computing, and it is increasingly becoming the standard for AI workloads at the edge. ARM generates recurring royalty revenue and benefits from powerful network effects. The more developers design for ARM, the more valuable the platform becomes. 2. OpenAI. Softbank has invested over $60 billion in OpenAI, giving it a stake estimated at around 13%. This is not a passive financial investment, it is a strategic partnership. OpenAI's models are the operating system for the AI era, and Softbank is positioning itself as the primary integrator of those models into enterprise and consumer applications. 3. Softbank Corp and SB Energy. The telecom and energy arms provide the infrastructure layer. Softbank Corp is Japan's second-largest telecom operator, and it is being transformed into an AI-native company, building data centers and deploying AI-powered networks. SB Energy is investing heavily in renewable energy to power the massive electricity demands of AI data centers. The financial structure. Softbank's financial structure is characterized by two features: high leverage and significant asset concentration. The company's net asset value is estimated at over 30 trillion yen, but it carries substantial debt. This leverage amplifies both upside and downside. When asset values rise, Softbank's equity value soars. When they fall, the debt magnifies the losses. The company also has a large cash position, over 3 trillion yen, which gives it the flexibility to make opportunistic investments or weather downturns. But the overall financial profile is one of a highly leveraged, concentrated bet on the AI sector. Recent performance. Softbank's recent financial results reflect the AI boom. In the third quarter of 2025, the company reported a net income of over 3 trillion yen, driven largely by the rising valuations of ARM and OpenAI. The Vision Fund, which had been a source of massive losses, returned to profitability as its portfolio companies benefited from the AI-driven market rally. However, this performance is volatile. Softbank's earnings are driven by mark-to-market accounting on its investments, meaning that paper gains can turn into paper losses just as quickly. The company's profitability is, in effect, a reflection of the market sentiment toward AI. Part 3: the competitive advantage. What is Softbank's moat? Strategic analysis often begins with a simple question: What is the company's sustainable competitive advantage, its moat? For SoftBank, the answer is complex and contested. The argument for a moat. Proponents of SoftBank's strategy would point to several sources of sustainable advantage. 1. Capital scale and speed. SoftBank's ability to deploy tens of billions of dollars quickly is a form of competitive advantage. In industries where scale matters, semiconductors, AI infrastructure, robotics, being able to write large checks can accelerate development, crowd out competitors, and secure exclusive relationships. 2. The ecosystem effect. SoftBank has built a cluster of number ones, a portfolio of market-leading companies that can collaborate and share data. ARM designs the chips. OpenAI develops the models. The Vision Fund portfolio provides the applications. This ecosystem creates synergies that are difficult for a competitor to replicate. 3. The Founders Network. Masayoshi Son has spent 4 decades building relationships with the world's leading technology entrepreneurs. This network gives SoftBank access to deal flow that competitors cannot match. 4. ARM's structural moat. ARM's position in the semiconductor industry is arguably the strongest part of SoftBank's portfolio. ARM's architecture is deeply embedded in the mobile ecosystem, and the switching costs for chipmakers are enormous. As AI moves to the edge, to smartphones, laptops, and IoT devices, ARM's dominance is likely to grow. The counterargument. Critics of SoftBank's strategy would challenge whether these advantages are truly sustainable. 1. Capital is a commodity. While SoftBank has been a pioneer in mega funds, other sovereign wealth funds, private equity firms, and even corporate investors have begun to match its scale. The advantage of being the only player with $100 billion to deploy has eroded. 2. Ecosystems are hard to manage. The vision of a synergistic portfolio is compelling, but in practice, coordination across hundreds of independent companies is difficult. Many of SoftBank's portfolio companies are competitors with each other, and the promised synergies have often failed to materialize. 3. Founder dependency. A competitive advantage that rests on one individual is inherently fragile. Masayoshi Son's judgment has produced extraordinary returns, but it has also produced significant losses. The question is whether SoftBank's decision-making processes would remain effective if Son were no longer involved. 4. ARM faces threats. ARM's dominance is not guaranteed. Open-source architectures like RISC-V are gaining traction, and major tech companies like Amazon and Google are developing their own custom chips, reducing their reliance on ARM's designs. From a strategic perspective, SoftBank's moat is real but narrow. It is not a fortress. It requires constant execution, and it is vulnerable to shifts in technology, competition, and market sentiment. Part 4. Governance, the founder-led model. SoftBank's governance structure is a case study in the trade-offs of founder-led organizations. The strengths. The primary advantage of SoftBank's governance is speed. With Masayoshi Son controlling approximately 30% of the company's shares and serving as both chairman and CEO, SoftBank can make decisions with a speed that is rare in large public companies. When major events occur, a geopolitical shift, a market dislocation, an investment opportunity, SoftBank can mobilize capital and execute in days, not months. This speed is a strategic asset in industries where timing is critical. The company's ability to raise $40 billion in new debt to fund OpenAI investments in early 2026 is a testament to this agility. The weaknesses. The weaknesses of founder-led governance are equally clear. The most significant is the concentration of decision-making authority. SoftBank's strategy is, in large part, Masayoshi Son's strategy. This creates what strategists call key person risk. If Son's judgment were to falter, or if he were to retire without a clear succession plan, the organization would face an existential challenge. A second weakness is the lack of robust internal challenge. While Softbank has strengthened its board in recent years, adding independent directors and improving disclosure, the culture remains one where Son's intuition carries decisive weight. This can lead to blind spots, as was evident in the WeWork investment, where due diligence was overridden by Son's enthusiasm for the founder. A third weakness is transparency. Softbank's structure, with its mix of public assets, private investments, and complex financing, makes it difficult for outside stakeholders to fully assess its risks. While the company has improved its reporting, the valuation of private assets like OpenAI remains a black box that depends on assumptions about future growth. From a governance perspective, Softbank represents a classic tension: the efficiency of centralized decision-making versus the resilience of distributed accountability. Part 5: 3 Strategic Lenses on Softbank. Now let's examine Softbank through 3 distinct strategic lenses. Each lens represents a different philosophy about how organizations should create and sustain value over the long term. Lens 1: the quality and durability lens. The first lens focuses on the durability of a company's competitive advantage and the predictability of its earnings. Proponents of this lens seek organizations with clear, defensible market positions, strong cash flows, and conservative financial structures. When viewed through this lens, Softbank presents a mixed picture. On the positive side, ARM is a genuine quality asset. Its market position is dominant, its revenue model is recurring, and its importance to the global technology industry is only growing. Softbank's telecom operations in Japan also provide a stable, cash-generating foundation. On the negative side, the overall structure of Softbank is the opposite of what this lens values. The company's earnings are volatile, driven by mark-to-market accounting on investments. Its balance sheet is highly leveraged. Its strategy is concentrated on a single theme, AI, which introduces significant risk if that theme falters. And its governance is dependent on a single individual. From this perspective, Softbank is not a quality compounder. It is a high-risk, high-potential bet whose value is tied to forces outside its control. Lens 2: the simplicity and visibility lens. The second lens focuses on the understandability of a business. Adherents of this lens prefer companies whose operations can be easily explained and whose financial performance can be clearly tracked. They look for businesses that are visible in everyday life, that have a simple value proposition, and that generate earnings that can be reliably forecast. When viewed through this lens, Softbank is challenging. Parts of Softbank are simple: the telecom business, the energy business. These are straightforward operations that anyone can understand. But the core of Softbank, the investment portfolio, the vision fund structure, the complex web of holdings, is anything but simple. The company owns stakes in over 400 private companies, many of which are themselves complex. Valuing these assets requires assumptions about future growth, market conditions, and exit timing. Moreover, Softbank is the opposite of a hidden or overlooked company. It is one of the most analyzed, debated, and controversial stocks in the world. Its stock price is driven not by steady earnings growth, but by market sentiment toward technology and AI. From this perspective, Softbank fails the test of simplicity. It is a company that requires constant monitoring and deep expertise to evaluate. Lens 3: the cycle and conviction lens. The third lens focuses on the identification of long-term economic cycles. Proponents of this lens are not looking for steady growth, they are looking for turning points. They study supply and demand dynamics, identify industries poised for structural change, and make concentrated bets at the moments of maximum pessimism. When viewed through this lens, Softbank becomes a compelling case study. Masayoshi Son is, in essence, a cycle hunter. He identified the mobile internet cycle early, placing a massive bet on Vodafone Japan. He identified the e-commerce cycle early, placing the Alibaba bet. And now he has identified the AI cycle as the defining economic shift of the next decade. Softbank's current strategy is a classic cycle play. The company is betting that the demand for AI computing power will grow exponentially. That ARM's architecture will be the foundation for that computing, that OpenAI's models will be the operating system for AI applications, and that the energy infrastructure to power all of this will be a critical constraint. The risk from this perspective is not that the cycle is wrong, it is that the timing is off. If the AI revolution takes longer than expected, or if the market's enthusiasm outpaces actual deployment, Softbank's highly leveraged position could be exposed. The discipline required is not just in making the bet, but in knowing when to hold and when to exit. From this lens, Softbank is a test of patience, conviction, and the ability to withstand volatility. Part 6: Risks and Future Direction. No strategic analysis is complete without an examination of risks and the company's forward strategy. The key risks: 1. Valuation and market risk. Softbank's net asset value is highly sensitive to the valuations of its core holdings, particularly ARM and OpenAI. If the AI market cools, if interest rates rise, if regulatory scrutiny increases, if adoption slows, those valuations could decline sharply, and Softbank's leverage would amplify the impact. 2. Execution risk. Softbank's strategy requires it to successfully integrate its AI ecosystem. ARM must continue to dominate chip design. OpenAI must continue to lead in model development. The telecom and energy arms must build the necessary infrastructure. Any failure in execution could undermine the entire thesis. 3. Geopolitical risk. Softbank is a Japanese company with massive exposure to U.S. technology and Chinese markets. Tensions between the U.S. and China, trade restrictions on semiconductors, or regulatory actions against ARM or OpenAI could all disrupt Softbank's strategy. 4. Governance and succession risk. Softbank's strategy is inseparable from Masayoshi Son. The company has not articulated a clear succession plan. If Son were to retire or become unable to lead, the organization would face a period of profound uncertainty. The future direction. Softbank's stated strategy is to become the world's leading AI infrastructure company. The 3-step plan is clear. 1. Upstream architecture. Maintain and expand ARM's dominance in chip design, particularly as AI moves from data centers to edge devices. 2. Midstream intelligence. Deepen the partnership with OpenAI, integrating its models into enterprise applications and building AI-as-a-service offerings. 3. Downstream infrastructure. Invest in the data centers, networks, and renewable energy that will power AI at scale. This is a vertically integrated strategy that seeks to capture value at every layer of the AI stack. Whether it succeeds depends on factors that are partly within Softbank's control: execution, capital allocation, governance, and partly outside it: the pace of AI adoption, the competitive response, the geopolitical environment. Part 7: Strategic Lessons from Softbank. So, what can we learn from Softbank as a strategic case study? Several lessons emerge. Lesson 1: Vision must be matched with structural advantage. Softbank's history shows that visionary bets can produce extraordinary returns. But it also shows that vision alone is not enough. The WeWork investment failed not because the vision of flexible workspace was wrong, but because the business lacked structural advantages, a moat, and because governance failures allowed the bet to grow beyond prudent limits. Lesson 2: Leverage is a double-edged sword. Softbank's use of leverage has amplified its gains during bull markets and its losses during downturns. For a company making concentrated bets on long-term cycles, leverage is a powerful tool. But it requires discipline. When the cycle turns, as it did after the Vision Fund's peak, leverage can transform a temporary setback into a crisis. Lesson 3: Founder-led governance has trade-offs. The efficiency of founder-led decision-making is a real advantage. Softbank's ability to pivot quickly from telecom to VC to AI is a testament to the speed that centralized authority enables. But the trade-off is fragility. Organizations that depend on a single individual must invest in succession planning, institutional processes, and a culture that can challenge the founder's assumptions. Lesson 4: Understand your business model's true nature. Softbank's early strategy was to present itself as a technology company. In reality, it was a leveraged investment holding company. The distinction matters. Technology companies generate recurring revenue from products and services. Investment holding companies generate returns from capital allocation. The two require different skills, different risk management, and different governance. Softbank's struggles in the Vision Fund era were, in part, a consequence of misapplying the tools of operating management to the world of investment. Lesson 5: Cycles require patience and discipline. The companies that succeed in capturing long-term cycles are not those that chase the hottest trends. They are those that do their own research, identify turning points, and have the patience to hold through volatility. They also have the discipline to exit when the cycle has run its course. Softbank's AI bet is a classic cycle play. Whether it succeeds will depend not only on the correctness of the thesis but on the company's ability to manage the timing, the leverage, and the emotions that come with concentrated positions. Conclusion: Softbank is not a typical company. It is a strategic experiment in what happens when one person's vision, amplified by unprecedented financial resources, is applied to the most transformative technological shift of our time. It has assets of extraordinary value: ARM, OpenAI, a global ecosystem of technology companies. It has a strategy that is clear, focused, and vertically integrated. But it also carries risks that are equally extraordinary: leverage, concentration, governance dependency, and exposure to forces beyond its control. For strategists, Softbank offers a rich case study in the trade-offs that define corporate strategy. The tension between vision and execution. The balance between speed and resilience. The choice between diversification and concentration. The challenge of building an organization that can outlast its founder. Softbank's story is not yet complete. The AI cycle it is betting on is still in its early stages. Whether the company will be remembered as the visionary architect of the AI era or as a cautionary tale of leveraged speculation is a question that only time will answer. But whatever the outcome, the strategic lessons it offers are enduring. Know your competitive advantage, manage your leverage, build resilient governance, and never confuse a compelling narrative with a sustainable business model. Thank you.